Hey, good afternoon, everybody. Hello, and thanks for joining us for our fourth webinar on the popular PPP loan program. I'm Ed Orlett, NAED Senior Vice President for Government Affairs, and we have some friends here with us from Brown, Smith & Wallace that I'll introduce in a moment. The application for forgiveness for the loan program is now available, and the SBA has said more guidance is coming. Look, no question this program has been very helpful. I think the biggest frustration that we have is the rules kind of keep changing. And a lot of that's a function of acting quickly. But it also makes people that get the loans nervous, and that's understandable. So as the world of PPP turns, we can still give you the latest information we have and continue to answer your questions. Again, there's lots of folks on the line today. So as always, dialogue will be a challenge, but we have a system in place for you. Here's how we'll do it. We'd like you to submit your questions by clicking on the Q&A button on your Zoom toolbar to ask your question. And you'll see the questions that are already in queue. And if your question has been asked already or something close to it, you can upvote it. And that way we'll answer the upvoted questions first. Also, you have the option to submit your question anonymously, but we'd encourage you to tell us who you are so we can unmute you if we want to have any dialogue around the answer to your question. You can also virtually raise your hand by clicking the hand button on your toolbar. If you raise your hand, I can unmute you and we can actually hear your beautiful voices. If an answer isn't clear and you want more clarification, you can raise your hand. Next, I'll answer the standard webinar questions. Yes, this is being recorded. It will be hosted on NAED's website. And yes, we will email everyone the link to the presentation along with the slides. You'll get the video and the slides today. So with us again today are our experts from Brown, Smith & Wallace, a tax and consultancy firm headquartered here in the newly reopened St. Louis County. First, let me introduce Jen Vacha. Jen is a partner in the tax practice at BSW. Welcome, Jen. And David Killion is a principal in the BSW Transaction Advisory and Litigation Support Services practice. David, again, thanks to you for joining us yet again for our third trip down PPP lane.
You bet.
So last time we spoke, we called the PPP program an odyssey, and we had yet to, we've seen yet another plot twist in the odyssey come about just yesterday, as we learned that House Speaker Nancy Pelosi has apparently committed to holding a vote on a bipartisan piece of legislation that could significantly improve the PPP program. That really wasn't on our agenda for today, but I thought we'd just briefly talk about that, since it's not inconceivable that this could happen. So Minnesota Democrat Dean Phillips and Texas Republican Chip Roy introduced the Payroll Protection Flexibility Act. Now, there's been plenty of bills introduced to fix the PPP program. The difference here is that this one's bipartisan, and the speaker has apparently committed to bringing it up for a vote. Now, why did she do that? She did that because she needed votes to pass the partisan Democrat HEROES Act, which is not going to be taken up by the U.S. Senate. So to get enough votes to pass it out of the House, she needed to make some promises. It's the old horse trading. And Phillips said she could have his vote if she agreed for her to call a vote on his bill. So his bill actually stands a chance of passing both houses and being signed into law. It would significantly improve the PPP loan program. While we've only seen a discussion draft of the bill, both sponsors released the major provisions late last week. And according to them, the legislation would allow forgiveness for expenses beyond the 8-week covered period. I know a lot of folks had concerns about that covered period. The goal of this thing is for employers to keep people on the payroll. So give them some flexibility to extend the loan proceeds. They also would eliminate restrictions on non-payroll expenses. And I think a lot of folks have had some heartache around this one too. 75% has to go to payroll, but this bill would eliminate that. It would make it easier for people to retain employees, which, there's no point in retaining your employees if you can't pay your rent. There's nowhere for them to go. It would eliminate restrictions on the loan limit, it would eliminate restrictions that limit the loan to 2 years. Especially the restaurant folks and some of the folks in New York said, hey, after 9/11 and after the financial crisis, it took us a heck of a lot longer to recover than 2 years. And it would ensure full access to payroll tax deferment for businesses that take the loans. Again, there was this issue about quote unquote double dipping. You couldn't do the payroll tax deferment if you were a PPP recipient. This would eliminate that. So it's not considered, it wouldn't be considered double dipping. The point of this is to get relief to struggling businesses. And finally, it would extend the rehiring deadline to offset the effect of enhanced unemployment insurance. And you all have seen this. Apparently, the unemployment insurance payments, now that the federal government's plussing them up, are higher than the median wage in 44 states. So some businesses are having trouble getting people back to work. So to mitigate this, the deadline to rehire employees under the PPP would be extended to align with the expiration of any enhanced unemployment insurance. So until that bill becomes law, we can only proceed with the rules that we have in front of us. Just understand that the potential is out there for this thing to be really made a lot more flexible. But for now, let's focus on the rules as they exist today. And to do that, I'm going to ask our friends from BSW to get us started.
Perfect. Thank you, Ed, and everyone within the NAED family. Thanks for having us back. Hopefully, you're not getting tired of hearing from David and I, but we are happy to be back and sharing more information with you. As Ed has alluded, there's a lot of information that's been changing within the PPP programming and obviously still within legislation at large. So while we do now have the ongoing guidance now for the Paycheck Protection Program and we have the loan forgiveness application out, there's still a lot of information still to come. So the normal flow for activity is a little bit reversed, and I'm sure David could put this a little bit more eloquently than I could, but basically it seems like we've got the cart before the horse right now. We've got some information for a loan and we have application instructions, but maybe not all the guidance. So what we're going to do with you today is walk through some of the SBA lending program guidance that is available, the changes from the last time that we've spoke, and then we'll go through some of the application information that is giving us some of the definitions. So that way, maybe some of those questions that have been lingering from day one or day 20 are maybe now going to be answered on some of these pieces that we can share with you. So everything is still fluid. It's still a very fluid environment. So hopefully this will help you continue on the path in the right direction. But eventually we'll get there and hopefully we'll be able to keep things moving for you. So to get us kicked off, I'm going to turn it back over to David, and he's going to walk us through some of the changes. And I'm afraid you're going to see a dizzying array of what's caused you a lot of chaos and headache over the last several weeks and perhaps the last 2 months with the kind of the IFR regulations as they've changed from day to day, week to week, and month to month. So David?
Great, thank you. So as Jen said, we're going to touch real quick on kind of what has happened since we last spoke. And I looked at my calendar. I think we've been apart now for about 3 weeks and a lot has happened. So just a quick update on the SBA programs. What you'll see is on April 24th, as most of you know, the funding prior to that was exhausted in what we'll call CARES 1. Then what came into effect was quote unquote CARES 2, so the Paycheck Protection Program, Healthcare Enhancement Act. This added an additional $300+ billion to the PPP program. It added another $60 billion to the EIDL program. And I think we had touched on this quickly during our last call, but Since then, what has happened is 513 billion of the, call it 660 billion, was funded as of May 16th. So that number reflects both rounds of PPP funding as well as cancellations through the report date. So what it doesn't include are some things like duplicative loans or loans not closed for some reason, or maybe even loans paid off. So, we're looking at 100 to 150 billion available still to be lent under this program. And those, if you've been following the news, loan volume has slowed tremendously. And I'll touch on that on the next couple of slides. But really, I think what happened is, as some FAQs came out, good faith certifications, need-based certifications, I think a lot of borrowers who were excited when this program rolled out dug into the details, maybe found out they weren't eligible, maybe they didn't fit the need requirement, were afraid, frankly, on some of the strong language being issued by the government related to the good faith certifications. Or you had restaurants, are a great example of somebody with a very high occupancy cost relative to payroll that thought, well, I'm not going to hit the 75-25. I don't want a loan. I don't need more leverage. So I think we've seen that slowed. I know we've seen it slow down quite a bit with some of the things that Ed touched on. Hopefully we can expand these programs, make them a little bit more enticing to borrowers, such that we start to see this borrowing ramp up a little bit. So dizzying is a good word to use for our next graphic here. So we put together a timeline of what has happened since May 27th and where we are now. The last thing hitting on here was IFR 11 on May 18th. So we've got the information and application that came out late March, early April. We've seen a slew of IFRs, loan calculation amounts, kind of culminating with the application here recently, as well as 5 or 6 very popular and hotly contested FAQs that have been coming out from the Treasury and SBA department. So here's really where we've been. Fund rounding 1, followed by round 2. And, I guess we'll see where we go here over the next 3 weeks. But this is a nice timeline of what has happened. It's also a way to find resources if you need them. Some things to think about. I will point out one of the IFRs for anyone on the call who has a partnership or applied and did not include guaranteed payments from partners. There is an IFR that recently came out that allows you to go back to your bank as long as they have not filed a 1502. Most banks have not, so hopefully you can get in before that is filed. But if you did not include guaranteed payments, you are eligible to request additional funds, which are then funded by the bank and included in your PPP. So if you have a partnership and you missed out on that, it's worth going back, take a look. It's IFR number 9 on our chart there, came out May 13th. So certainly something to look at. Touch real quick here on a couple FAQs, as I mentioned. So FAQ 31 and 37 were our first blush with the media backlash on rich companies, I guess we'll call them for lack of a better term. So companies with a lot of money that took these loans that were big. Ruse Hospitality was one. The LA Lakers were one. There's a laundry list of public companies that probably shouldn't have taken these, but managed to find some eligibility. So those two came out, got a lot of companies to repay their loans. That date was extended twice, once to the 14th and finally to the 18th, which was Monday. So that money has been repaid. FAQ 43 and 47 also came out. And so with FAQ 46 and 47. So 46 had to do with borrowers of less than $2 million being deemed to have filed their application in good faith as it pertains to need. If you are in excess of $2 million, you could still qualify for forgiveness, but needed to include some form of documentation to substantiate needs. So that was some really good guidance. I think we got to put the minds of a lot of folks at ease who I think were very nervous about this. A lot of businesses we talked to that were well deserving of these monies and desperately needed them were kind of in panic mode. And so I was excited to see this out. It really takes a lot of the fear out of it for less than two. Even if you're over two, the process generally is that the SBA is going to review, quote unquote, review. It is not an audit. That BSW isn't going to come in and perform an audit on your business or anything crazy like that. The SBA is simply going to review your need for the loan. If they make a determination that you're good, then you get to keep it. You follow along with forgiveness. Everything is copacetic. If they deem that you do not meet that requirement, what they're going to do is ask you to repay the loan. They're going to notify the lender that it's not eligible for forgiveness. As long as you follow what they want you to do, then they will not, quote unquote, refer you to other departments or organizations. So essentially, you're not going to face criminal investigation or run into any sort of issues if you felt you applied in good faith. They decide you didn't, pay the money back. That's kind of their way of saying no harm, no foul. So some really good guidance. Hopefully it put some minds at ease, but it was nice to see, and hopefully that, to circle back to our original conversation, hopefully that gets the money kind of flowing back out and gives borrowers a little bit more confidence that if they need it, then they should take the money and spend it as it was set forth to do. So with that, we'll move on to our first section here. So loan forgiveness application released. So like I said, that came out on May 15th, as we saw in our chart. So the basic structure of the application is the application itself. It's about a page. We have Schedule A, we have Schedule A worksheet, we have a documentation form, and then we have a borrower demographic information. Sorry about not advancing the slide. So there's everything I just said. So the way to look at this, we'll touch on some of these aspects as well. As you get into the application, what you'll realize is similar to most tax forms, you start at the end and work your way backwards. So Schedule A worksheet is really the starting point. It feeds a lot of the lines in Schedule A. Schedule A then feeds lines up into the application form. So it is nuanced, it's complicated, it's going to require some Excel, it's going to require documents, calculating FTEs for periods. It's not the easiest thing in the world. So, kind of a plug here, not only for us, but for your advisors as well. If you have someone who can help you, if you need help, raise your hand and ask. This is a pretty big deal as far as forgiveness goes. The last thing that we or your advisors want you to do is foot fault or misstep because you got confused and end up with a loan at the end of this period. So please don't hesitate to reach out to your advisors and make sure you're understanding this. This is a hot topic for all accounting and law firms. There's a lot of good information out there as well. So please speak up and make sure you get these schedules right. So the application itself provided quite a bit of clarity. As Jen said, we don't have narrative regs yet or FAQs or anything. So it's kind of reading instructions, which as accountants we're used to doing, of course, but it's not the easiest thing in the world. So I apologize for that. But what we're going to do is run through these bullet points. I'm going to turn it over to Jen in a sec. And we kind of want to hit the highlights with this one, right? We're waiting on more guidance. We're digesting the application. So what we want to do is discuss what changed and then, let the group kind of run off, digest the applications, and then maybe we'll circle back with some more information for everybody. So with that, I will turn it over to Jen.
Perfect. Thank you. So obviously, as David said, one of the big things that came out with the early rounds of information with PPP is, what do I have to keep track of? The documentation has always been alluded to that we have to have the information to support our claims for either a good faith estimate and that our full-time equivalents were the same, that we didn't have the drops in payroll. So now we do actually have, through the instructions, through the application itself, some of that guidance. As David noted, we don't have the regulatory information in a more plain language way to read it, but we have a form. In a sense, it looks very similar to a tax form, and we have the instructions that go with it. So for me, from a tax position in a public accounting firm, I can work with this. This is stuff that I can go through and decipher and try to spell out as much as we can. So I know David already mentioned it, but by far, if you wouldn't go about doing your own tax return by yourself, definitely seek out your advisors, because they're going to be skilled at actually reading through this information and digesting it and helping you get on the right track. So without further ado, we'll jump into some of the documentation pieces, so that way you at least know offhand what you should be keeping track of now that we have a little bit more clarity. So from a payroll perspective, they've finally highlighted that definitely you do want to keep those bank statements, the payroll provider reports. Those things are all going to be able to help substantiate and document that compensation that's paid out. The other things that they are going to be looking for you to submit with your application, again, these are things to be submitted. They're going to be looking for the IRS payroll tax form. So if it's a quarter that hasn't been filed, they potentially are going to be asking for draft copies of those returns. Typically, that's going to be your 941. You'll also generally have a state unemployment and a state payroll tax report that gets filed probably on a quarterly basis as well. Most of the states refer to those as a 941 as well as the IRS form. So keep those documents on hand. They will be required. The other interesting thing with the payroll component is when you're submitting your application, there's, and David, correct me if I'm wrong on this, but I think there's a part of the certification that you actually go through and say that you acknowledge that it's okay for SBA and the regulatory agencies, whether it be IRS or the state, to actually share this information back and forth if something doesn't add up and they think there's an issue. And again, that comes into that potential for fraud or for a civil or criminal penalty issue. So just being aware of that. The other things that you will keep on hand and be able to submit are the receipts and canceled checks, any of your other account statements that would support the fact that you made the contributions to your employees' health or retirement plans. So for those benefits, you're going to keep those documents in place as well. On the full-time employee headcount, we're going to go to non-payroll. Non-payroll stuff, we have, we talked last time about what non-payroll costs were eligible. So that was the mortgage interest expense. So they do want you to keep track of the amortization schedules, any receipts or canceled checks. Alternatively, you might have a lender account statement that you'd be able to submit. The similar would be true for your lease or your rent payments, the lease agreements, the canceled checks, or the actual lease agreement itself. Utility payments, they're looking for invoices, receipts, canceled checks, account statements, same as, it seems to be kind of a repetitive story there, but they're looking for consistency in that material. The other thing to keep in mind, you'll see the asterisks on these. If you recall from our one of the first set of conversations that we had, the non-payroll component is for obligations that were in place prior to February 15th of 2020. So it only seems fitting that the information they want you to submit as support is going to be for February 2020 and through your covered period. And then it's actually even for 1 month after your covered period. So it shows that it wasn't just something temporarily pulled into play to perhaps modify the situation and be able to spend more funding that you really weren't maybe obligated for, or that you didn't go and change something that maybe shouldn't have been modified. So keep in mind those extra dates there as well.
Hey, Jen.
So, go ahead.
While we're there, somebody's upvoted the question I think we can answer quickly. Rent paid to an affiliated company is eligible for forgiveness, correct?
So the related party component in regards to rents and leases has been an issue, and it has not been specifically addressed. It's We are under the impression that yes, as long as it's documented and supported by a lease agreement and you have something that is an arm's length transaction, but there's nothing firmly been issued on that. There hopefully will be some more guidance in regards to the related party entities in that regard, but we don't have anything solid yet. Our opinion is that it probably is, especially if you have that lease agreement in place to document it, but otherwise we don't have anything to confirm, yes, it absolutely is.
Okay, great, thank you.
I think I saw either a chat pop up or another thing. Somebody asked about maybe a real property versus personal property. And there is something that came out with the guidance in the application itself. So where we're talking here about the business rent or lease payments, early on, all of the dialogue had been around these non-payroll components, truly covering occupancy-related expenses. And so it had been the popular opinion that the rent and lease payments were only for your occupancy space, those real property leases. The way that the guidance is actually written in the instructions is it does actually say real or personal property. So depending on your circumstances, again, you want to keep that in mind. You're spending on the non-payroll component, keep that in mind with your 75-25 splits. Even if you're allowed to spend on those purposes, if it's going to negatively impact your forgiveness, you still may not want to take that opportunity and just utilize those expenses. So while the instructions now say real and personal property, you still want to take that with a caveat of what makes logical sense for your operations overall. If we go ahead and go to the next slide. So the other thing that we want to highlight, there is another probably 2 or 3 slides that we probably could have put in here with other documentation pieces. So there's a lot of information that has to be documented, but we're trying to hit the highlights for you today. The other component that's really relevant to keep in mind are the documents that you need to keep in place in your files. So they don't have to be submitted with the application, but you do need to retain them. And the significance, we've highlighted this in yellow here, is they do want these documents retained for 6 full years after either the date of forgiveness or the date the loan is paid off. So set up your document retention policies properly, make sure you've got them in a good place, because these are all things that you're going to need to keep on hand just in case. I won't go through the enumerated list here, but like Ed said, you will get a copy of the slides. So hopefully it'll be a nice quick bullet point that you can walk back through afterwards. And then this bottom bullet point here is what I was referring to about providing that permission for the authorization to the SBA to access these files upon request. So they're going to have the ability to request this information as well, even though you don't have to submit it. All right, so on the forgiveness period cutoff, so what we've talked about at length, it seems, with the application process itself is the 8 weeks, and that's your covered period. So that's typically been referred to as your loan disbursement period. The covered period for PPP loans, if you recall, essentially was from the beginning of the ability to file through June 30th is the overall covered period for PPP lending. When you look at the loan that you have now at your disposal, you have a covered period to be able to spend the funds. That's that 8-week period. So what came through the guidance with the application for forgiveness was more of a solid definition, because depending, you could look at something and say, well, 8 weeks is roughly 2 months. It's roughly how many days? They have finally clarified it and said, we really want this 8 weeks to be the 56-day period. And that becomes relevant in, and I believe David will cover this in a little bit, it becomes relevant when we talk about that $100,000 compensation cap and how you actually calculate that through your covered period. So your covered period typically is going to be 8 weeks, 56 days. If you run your payroll on a biweekly or shorter period, so more frequently, then you have the option at your discretion for administrative ease to elect this alternative period covered period. And that's a long drawn out way to say, basically you can start your covered period for certain cases on the first day of the next payroll period that occurs after your loans are dispersed. So think I said that all correctly here, and it goes then to 56 days after that. So rather than just being immediately from day one of funding and going 56 days, if you are running biweekly or more frequent payroll, they're giving you an opportunity to say, we're going to start our covered period with the first payday after our loans are dispersed and run 56 days after that. So an example there would be if your payroll normally works on a Sunday to a Saturday timeline, you're a weekly payer, and you get your loan on Wednesday, do you have to then go through and bifurcate and then have a shortage and try to do some manipulation there? And the answer is no. If you're paying weekly, you're paying more frequently than biweekly. So you could make this alternative election for administrative ease, and you would actually start your alternative covered period starting with that following Sunday, and then your timeline will run along that component. When you're looking at the application for forgiveness itself, there are some pieces that say specifically covered period, and there are some pieces that say covered period or alternative period covered period. So you have to be aware, if you use an alternative period covered period, you must be consistent in that methodology. So just be aware of that when you're looking through that component. The other benefit here is if you're able to use that alternative method, it really eliminates the need maybe on the back end of your forgiveness period. It eliminates the need to have to run a special payroll cycle. So you're not having to cut off. You would have the ability to run your payroll normally, not have to take a bunch of administrative steps and hoops to jump through to make things happen prior to the actual end of that 56-day period. All right, what else do we have? I think now we're going to move over. Do we move over to David, I believe? Oh, did we lose our slides? There we go. All right, so David's going to walk us through these payroll costs again.
All right, so as Jen went through the alternative payroll covered period, we'll start to factor in. Those are terms you're going to hear. And generally speaking, what I will say as far as planning and strategy goes with these forgiveness calculations, the election between covered period and alternative payroll cover period, that is planning opportunity number one. So if we speak to things where you get to elect one or the other, the answer is do both in your calculations and decide which one is more beneficial. Now on the AP, we'll call it APCP to make it easy. On that one, as Jen said, you will have to run that through some other spots on the form where it says or alternative payroll covered period. You do have to use that. So it is an all or none. You're either using it or you're not. But if it just says covered period, you don't have to use it. So that's planning opportunity number one to write down and discuss with your advisor as you're going through these calculations. So compensation, as we discussed before, that $100,000 limit on an annualized basis is still in play. Nothing has changed there. That last bullet point, it is cash compensation only. It is not non-monetary benefits like retirement, health insurance, taxes, et cetera. So this is going to be base comp. They did put some language in here regarding raises. So raises are going to be prohibited for owner employees. So if you are call it a C Corp, and you have an owner that is an employee, they cannot take raises. What we don't know is what is defined as an owner, right? So is it a majority? Is it a greater than 20%? Is it anyone with any sort of equity stake? Frankly, we just don't know. So that's a question mark, but something to keep in mind as you're going through this 8-week period is to be conservative, right? So if owner could mean anyone that has an equity stake, just be very mindful of pay increases. Next up, self-employed individuals. So if you're a self-employed business, that is going to be you. And then general partners in partnerships are going to be covered there as well. So the maximum there is going to be the $15,385. That is going to be during the covered period. So there's no need to test this on a biweekly, semi-monthly, weekly pay rate. 15,385 during the entire period, whether it is pro rata or if your payroll cycles are lumpy, that's the cap. So keep that in mind, and that is a ceiling. So if your owner made less than that in 2019, you don't get the 15,385. You get the lesser of what they made in the prior year, averaged out, or 15,385. So that's important to know. And again, even with that first bullet point, if they made 14,000 comparative, you couldn't give them a raise anyway. So that's specific to owners on the raises, and then 15,385 is going to apply to everyone on the count. Next up, we've got the overarching subject of incurred versus paid, which is an interesting one. They put a lot of language in there to clarify some things. They also put a lot of language in there that I think creates a lot of opportunities. This is one. So let's start with incurred. So payroll costs incurred but not paid during the period are includable if paid by the next paid date. So if your wages straddle the end, but they were incurred, they are includable as long as they're paid by the next pay date. We're also going to see a similar concept as it relates to non-payroll costs and paying invoices by the next pay cycle, but that is one item that would fit into incurred. The other piece of that is going to be paid. So payroll costs are considered paid on the date paychecks are distributed when the borrower initiates ACH. So here's the really interesting thing about payroll costs as it comes to paid. They do not speak, for those of you on previous webinars, we discussed delinquent obligations that related to prior periods before forgiveness. So acceleration is out, and it's still out. What I'm referring to is delinquent payroll and non-payroll costs, or maybe you accrued retirement benefits, for example, in 2019, and you calculate those and then pay them out on a single pay date in 2020. Doesn't say you can't pay those during the forgiveness period as of now. Doesn't say you can't pay 3 months of delinquent rent in the forgiveness period. All it says is if it's paid and it's eligible, you get credit. So I'm cautiously optimistic that we got some flexibility here in order to maximize proceeds, but again, cautiously optimistic. So there's certainly some planning here. The last bullet point has to do with insurance. If you are a self-insured employer and you have claims you need to pay out, according to the existing language, pay them out during the 8-week forgiveness period, and they will be accepted. So this is a big area for planning and strategy as it comes to maximizing how you use those proceeds. So when we get more narrative guidance, we're certainly going to dig into that and see if this was a unintentional, rather than saying incurred or paid, it should have said incurred and paid. That would be one way to fix this, but we'll have to see. So keep an eye out, and if you're signed up for our newsletters, I can assure you we'll have something very detailed if that rule changes, because this is an exciting area for a lot of folks who are trying to figure out how to use all this money. So next up, we'll dig into non-payroll. Touched on this a little bit. Again, I think Jen mentioned earlier, our mortgage and rent obligations definitionally expanded to include both real and personal. We had taken the approach, along with most, that this was specific to occupancy and things like auto leases or copier leases or personal property leases and purchases were not included. As of now, the guidance is taking a broader approach to that. It's good, certainly, that can be forgiven. We still have that 25% cap we're going to hit, so it's maybe not as exciting as the payroll piece, but certainly a way to try to get more expenses within this forgiven amount. So keep that in mind. Again, we get into incurred or paid as it relates to these non-payroll costs. And so if the expense is incurred but not paid during the covered period, still includable if paid during the next billing cycle. So if that billing cycle ends after the period, but you pay it, we can still get those in there. So that's another good thing, because a lot of times we have, utility bills that might not be perfect, but they've made that administrative burden a little bit easier and I think more digestible. So one thing that I'll end on with the payroll piece, and we'll go back real quick. I don't think I mentioned it, but planning, as I said, with covered period versus alternative payroll period, right? So the reason you test both is because depending on when you got your loan, if you were funded and the next day you received, you had a payroll hit, there are calendars and payment cycles where you might get 9 payrolls in there. Again, cautiously optimistic whether or not that's going to be includable, but this is why you want to map out those payroll dates, is to see if I use this method versus the other, can I sneak an extra payroll amount in here? And that's just part of the strategy and going through different iterations and versions of this calculation. And complexity is challenging, but I find that the more complex things are, the more opportunities we can find in them about that. So next up, we're going to hit on the 75-25 split. So again, this conversation and topic really related to the collar, quote unquote, the 75% payroll was a floor, the 25% non-payroll was a ceiling. So the way this is going to work is we still have our FTE headcount reduction test. We still have our payroll salary hourly wage reduction. However, the good news is that these are not stacked on top of each other, and they are ordered in such a way that you're not going to be penalized by all of them. So generally speaking, the 75% rule, that needs to go to payroll costs. The way that limiting factor is going to work, line 1 on the application is going to be your payroll costs. Divide that by 75%. That is going to be one of 3 limiters on this application. If that limiter is not the ultimately the most restrictive, then it's going to go somewhere else. So that's something to keep in mind. You'll see that on page 1. It's lines 7, 8, and 9, I believe, will show you those limiting factors on forgiveness. The other piece of this is that there was some concern that the 75% will be all or nothing. If you don't hit it, you're out. That is not the case either. So what's going to happen is you are going to be limited on forgiveness to the extent that you hit that 75-25 collar. However, if you don't, it is going to be reduced, and it is not going to be reduced in full. So I think that was good news. We had a lot of clients on our end who were concerned. Take a restaurant I mentioned earlier. We've got a 50% occupancy cost and a 50% payroll cost. What do I do? Should I even bother getting the loan? Well, the answer is yes. Unfortunately, you will have some sort of a reduction on forgiveness, but it's not all or nothing. So I think that was a nice provision that we saw that, again, added some comfort, some clarity to where we were seeing on that forgiveness limiter. And so with that, I'm going to turn it over to Jen to talk FTEs.
Yeah, thanks, David. And with the FTE, we get to kind of go back on something we talked about on the last session. So we go ahead and jump on into full-time definition through SBA for PPP. They will truly make a liar out of me, because I believe we sat here last time and told you that the SBA was using the 30-hour per week calculation to define their full-time employees. And lo and behold, when they decided to issue the application and the instructions, they have changed it now back to 40. So it goes back in line with what we would normally expect to be a full-time employee at 40 hours per week. They have also provided in the application itself, there are two tests. There's a simplified test and there's a more detailed test that go into evaluating essentially what your headcount numbers actually are. And as David said, on these other issues with the covered period and the APCP, you do want to use the multiple factors and try to figure out what your bases are under each component, because in some cases you could truly end up with a better benefit by taking the steps and taking the time to go through and do the multiple iterations to see where you actually stand. And the full-time equivalency is no different. So that's going to be something that you'll definitely want to pay attention to. One of the safe harbors that they have really lined out and itemized in the application as well as in the instructions are who you do not get penalized for if they are no longer in your headcount components. So if you did have to terminate an employee for just cause and it's documented and there's written documentation to support that, if you had an employee voluntarily resign and there's written documentation to support that, if you have an employee that voluntarily approached you and said they want to reduce their hours and you abided by their request that was written and supported in your documentation, then those are also not included as a negative. The other component to keep in mind is that you'll recall that we talked about the rehire exceptions for not counting against you. So if you had, say you had gone through and had to make payroll adjustments prior to April 26th, so you hit that cutoff period there prior to April 26th, and now you go and make that individual an offer to come back to work. If they decline to come back to work for you and you have that as a written offer that was declined in writing, then that won't count against you either. So I think you'll find a trend there. There's written documentation, written support. IRS and SBA, they're going to be hand in hand on this. They want to see things in writing to support the fact that it really did occur and that there was a legitimate purpose behind it. So if you did have those components, then you can consider them part of your safe harbor and not have to be looked at negatively from the headcount reduction. If you do have other reductions and they don't hit any of these safe harbors, then unfortunately you will be looking at a reduction to your maximum forgiveness. But again, as David said, just because you're not going to get 100% forgiveness doesn't mean it wasn't worth the while, because it might have caused other benefits to incur for your organization for the long run. Let's see here, if we go over to the next, we'll talk about, so in addition to the headcount changes, we always have the other component on the 25% drop in salary. So two phases there, and the 25% hasn't changed, at least not until this point. We're not expecting anything to change here either. As David alluded earlier, there not only is the current calculations that you're looking at, but we're also looking at a slightly modified timeline. So with the instructions to the application, we have the comparison period is now January 1 through March 31. So effectively, it's giving us the whole first quarter of 2020. If you wanted just a quick summary, we're also looking at those individuals from the $100,000 cap. And when you divide that out using the 8-week methodology that they've now strenuously stressed, that we're not doing it on 2 months, you do have the breakdowns here of that $8,334 on a monthly basis, which gets us back up to that $15,385, I think it is, and then $1,924 on a weekly basis. So you have those numbers in place. The significance here is when you get into the application itself, and as David said, we really are going to start with the Schedule A worksheet. There's a table that has to be completed, and that table will have to enumerate every single employee you have line by line. Table 1 is going to be all your employees that are less than 100,000, and Table 2 is going to be all of the employees that are over 100,000. So there's definitely a lot of activity that has to be kept track of from an employee perspective for their payroll components on an individual basis, and that's where this will be significant.
Yeah, and sorry about that. I didn't realize it was going to type as I updated the title, but that what Jen is describing on the 100,000, that's on the salary and wage reduction piece, not the FTE. So I did want to point that out. And again, another great planning opportunity, look at those payrolls from 2019 if this is going to be an issue. If you paid maybe a year-end bonus of a couple $1,000 and it hit 1 week, you might be able to kick all of your employees out of these salary and wage reduction components. So something to keep in mind. And sorry about that, Jen.
Oh, you're fine. I saw the typing. I was like, what did I do? Like, I'm not touching anything, I promise. The other component that we'll talk about with the FTE is the safe harbor. So one of the other pieces that we had talked about previously was if you did have reductions in your payroll staff, if you were to bring everyone back in and reiterate your hiring components by June 30th, then that wouldn't count negatively against you either. And so that is affirmed in a sense in the application, in the instructions that we have with the form. The caveat again is that those are only for those reductions in staffing that were done prior to April 26th. So if it was between February 15th and April 26th, you have until June 30th to get them restored, and it won't count negatively against you in your application process for forgiveness. So I think that kind of covers like as high as we could possibly get on this whole component. Again, we would just want to reiterate to use your resources, whether you choose to definitely can go through and utilize us. You can utilize your existing providers. I think David does have the next slide. Our resource page is constantly updated. And in fact, we've actually had to create a new landing page specifically for the CARES Act loan consulting work. David, Bianca, and myself will actually be hosting a webinar through Brown Smith Wallace. Today's Wednesday, right? Yeah. Tomorrow morning at 9 a.m. If you are dying and can't wait to go step by step through this whole application process, we do have a 90-minute webinar set up for tomorrow. I'm pretty sure we're getting close to max capacity on that. So if it's something that you'd be interested in, you can go to the website and actually sign up either for a recorded copy of that webinar, or you can try to participate live if we still have spots available. So definitely feel free to reach out there. On the landing page, we do also have the Q&A box that if you've got a burning question and your advisors aren't able to help you with it, there is a box that you could type in your information and it will go directly to David and Bianca and the rest of the CARES team and myself so that we can get responses back to you as quickly as we possibly can. With that, I know I've seen lots of questions popping up on the dialogue boxes, and I'm sure Ed's been doing a fantastic job looking them over and trying to moderate them for us. So I think David and I would be willing to attempt to answer some questions, assuming we still have some time here.
Yeah, we've got about 8 minutes. And I think the first one, the one that's been upvoted the most, I think we got at that earlier, but I want to make sure because, you know, accountancy is a dark art that is very foreign to me. So but Carol asked, or Carl asked, and 6 other folks upvoted it. Since payroll forgiveness is now considered to be for that either paid or incurred during the covered period, we have a biweekly payroll with a 1-week lag to payment. Does that effectively mean we're able to get 9 weeks of payroll, 8 weeks paid and a lag week incurred but not paid? I expect this is wishful thinking. And David, I think you commented on something sort of tangential to that. So,
yeah, I did, and I would echo the wishful thinking sentiment. Carl, I think I'd use the term cautiously optimistic, but you know, right now what it says is if it's paid during the covered period. Or the alternative payroll covered period. And then those 2 terms really just impact when your period starts. That's a little bit of flexibility to say it either starts when you get the money or at the first date of your pay period, either one. So what is going to happen is you want to know both, such that if you adjust that, you get to sneak in that elusive 9th week of payroll. So as it stands now, if the timing works out in your favor, you very well might get 9 weeks of payroll depending on the pay cycle and how that marries up with your covered period, alternative payroll covered period.
So I guess cautiously optimistic is the answer there.
Yeah.
Luke asks, our company's 401k contributions are via safe harbor and profit sharing and distributed to employees at the end of the calendar year. How do we account for those contributions if they are not technically distributed within the 8-week period?
So right now, if I'm understanding that correctly, if you use a safe harbor and they're paid out at the end of the year, the way the guidance sits now is they would neither be incurred nor paid. So you're kind of out from a 401k standpoint. Again, I'm hoping for some guidance to clarify this because we have a similar issue around bonuses. So if you're on a bonus cycle such that bonus hits in a pay period that extends beyond, then technically the bonus isn't forgivable either, which I think is going to be an issue. That's going to hit you a few different ways, especially as it comes to these payroll reduction tests. So my recommendation is let's see where the guidance goes. If the incurred or paid language stands, and if you've already paid the 2019, then that part is out. But as far as 2020 goes, there is nothing that says currently that you can't do a special payment, we'll call it, quote unquote, or not a special payroll even, but just a payment, right? So if you made a contribution at the end of the forgiveness period to partially fund the 401k contribution, technically, if it's paid in the period, it's eligible. If you have an employee that earned a bonus during the forgiveness period or is paid during the forgiveness period, then it's includable as well. So again, I think that comes down to timing and strategy and things you should discuss with your advisors. My overall suggestion is always to start with the easy stuff. Hit the low-hanging fruit. If you get to 75 or more with that, you're done. There's no sense in creating more work for yourself. If you don't get there, or if you have too much non-payroll, then that's the time to start brainstorming about, okay, how do we get this forgiveness amount up as it relates to payroll within the framework of the regulations?
All right, good. Scott asked, we use credit cards to pay certain utilities. Bill is paid when due. However, the bank doesn't take cash from our account. 45 days later. What does that do to the incur and paid for the 25%, non-payroll portion? I'm not clear about the wording on that one.
Yeah, I guess if you use, so a lot of companies use credit card. I mean, you get the points or however you want to do it, but they get, or maybe cash back. So they use credit cards to pay expenses. Like I said, you get the points or cash back and you extend the payable cycle by 30 days. I would think as long as those utilities are paid during the covered period or paid within one billing cycle after the period ends, then they would be includable. Credit cards are not. You would want the actual invoices. And one thing I will point out is, as it relates to credit cards, if you have interest expense that does not fit in the mortgage interest bucket, it is still eligible to be paid using PPP loan proceeds. However, it's not forgivable. So if you're paying interest on credit cards, you can use the loan proceeds. It's just not forgivable. And that would extend to that was that any other debt obligation bucket that we talked about previously. So again, it's eligible. You're not going to get in trouble for paying it. It just isn't eligible for forgiveness.
We've got a couple minutes left, so I'm going to try and hit a couple ones quickly. This is an oldie but a goodie. Are truck leases included in rent payments?
Yes. So as far as I'm concerned, that is a personal property lease arrangement.
How long do you have after the 8-week period to file the forgiveness docs?
So that one we don't know.
Okay.
Point out that the program expires June 30th. The forgiveness form expires October 31st. take that for what it's worth. You know, that timing works out pretty nice between an 8-week forgiveness and an 8-week turnaround for banks to approve. So that's what I'm thinking that's alluding to, but we don't have a definitive answer.
I'm going to try and find one more in here that's not too in the weeds.
And
Go ahead, Jen.
I was going to say, let's do the quick one. I see this question come up a lot. There looks like Dave was asking about clarification on the transportation included in utilities. So that was, and David and I have had this conversation on multiple occasions recently, that transportation component as a bulleted point for utilities really is in the guidance for a self-employed individual filing a Schedule C. So that actually talks about their transportation for Schedule C purposes only as a self-employed person. So my guess is that's probably not going to be relevant for many of the folks on this call.
And I've got, it's just 3:30. Are there any of these top 3 or 4 that you guys want to try and answer very quickly?
David, correct me if I'm wrong here, but Philip was asking about if you pay monthly, can you start on the beginning of the new month? I'm assuming he's referring to the idea of the APCP, the alternative period, but that's only available if you're on a biweekly payroll or more frequent. So if you were our monthly payroll person, it wouldn't be an eligible opportunity.
Yep, that's correct.
So, all right. Well, listen, we told everybody we'd go for an hour, and that's what we've got. We've got some open questions left, and we'll kind of go through these and try and get some answers for you guys individually. But again, thanks so much to our friends at BSW for generously giving us their time today and 2 other times. And, you know, I think to Jen's point, this is going to continue to evolve, and BSW is going to continue to do informational webinars. You got a great source of information. They've helped us so much. So we're going to thank them again for their time and their generosity with us. And we'll do our best to get you guys some answers to these questions. The slides and the video will be available. You'll get an email letting you know when and where. Thanks again, everybody. Thanks for your time. Stay healthy. Take care of each other. Take care of your family and friends. And we'll get through this. But thanks for joining us today. Thanks, everybody.